company makes money from software, SaaS, game development, patents, or other intellectual property, Cyprus has one of the most important tax regimes to understand. It is called the IP Box regime. The promise sounds almost too good. Cyprus allows an 80% deduction on qualifying IP profits under the Nexus approach. In 2026, with corporate tax moving to 15%, that can mean an effective rate of around 3% on qualifying IP income. But there is a catch. Not every software company qualifies, not every income stream qualifies, and simply registering a Cyprus company is not enough.
The IP Box is a tax regime designed for companies that create and commercialize intellectual property. The idea is simple. If a company develops qualifying intellectual property and earns income from it, Cyprus may allow a large part of the qualifying profit to be deducted for tax purposes. Cyprus applies the Nexus approach. That means the benefit depends on real research and development activity. The more the company itself develops the IP, the stronger the basis for the benefit. So this is not a passive park your IP and pay less tax scheme. It is meant for businesses that actually build technology. For tech founders, the most important qualifying asset is usually copyrighted software. Other qualifying assets may include patents and certain intangible assets that are legally protected, useful, novel, and non-obvious. This is why the regime is especially relevant for SaaS and software product companies, game development studios, AI and automation tools, including technical platforms, and some software agencies that own reusable proprietary technology. But there is an important distinction. A custom service agency that only sells developer hours may not have the same IP Box argument as a company that owns and licenses a real software product. Here is the simplified logic. Suppose a Cyprus company has 100,000 euros of qualifying profit from eligible software IP. Under the IP Box regime, 80% of that qualifying profit may be treated as deductible. That leaves 20,000 euros taxable. If the corporate tax rate is 15%, tax on that remaining 20,000 euros is 3,000 euros. So, the effective tax burden on the qualifying IP profit is around 3%. This is why the regime is powerful, but the word qualifying does a lot of work here.
The central concept is the Nexus approach. In practical terms, Cyprus wants to see a connection between the tax benefit and real development activity. That means the company should be able to show who developed the IP, where development happened, what costs were incurred, which income came from the IP, and how the qualifying profit was calculated. For SaaS founders, this is where accounting becomes strategic. You cannot simply say, we are a tech company, so all income is IP income.
For SaaS founders, the hard part is often not understanding the tax rate. It is separating the income streams. Subscription revenue, licensing revenue, implementation fees, support, consulting, and custom development may need to be analyzed separately. Some revenue may be connected to qualifying software IP, some may be service income, and some may be mixed. The cleaner the accounting, the safer the IP Box position. The Cyprus IP Box is usually most relevant for companies that own and monetize technology. A SaaS company with its own platform is a strong example. A game development studio with original game software may also fit. A software company licensing its own product can be relevant. An agency may qualify only if it owns real reusable IP, not just client work. This is the key point for founders. The regime rewards intellectual property, not general IT activity. Founders should be careful in 4 common situations. First, when the company only owns a brand or trademark. Second, when all software was developed by another company and simply transferred to Cyprus without substance. Third, when the company cannot separate IP income from service income. Fourth, when there are no proper records of development costs, contracts, ownership, or R&D activity. In these cases, the tax benefit may be challenged or may not apply as expected. So the correct question is not, can I register in Cyprus and pay 3%? The correct question is, which part of my profit is genuinely qualifying IP profit.
This is where Icon.Partners can help. For tech founders, the task is not just registering a Cyprus company. The real task is understanding whether the IP box fits the business model, which income may qualify, how the IP should be documented, what substance is needed, and how reporting should be organized after incorporation. At Icon.Partners, we help founders assess Cyprus as jurisdiction, coordinate company setup, structure the compliance logic, and work through the practical questions around IP, tax reporting, and banking. No generic low tax promises, just a structure that matches the business. So, what is the real takeaway? The Cyprus IP Box can be extremely attractive for software and technology companies, but is not automatic. The company needs qualifying IP. The income must be connected to that IP. The R&D logic must be documented. The accounting must separate qualifying profit from other revenue. And the structure must make sense commercially. In 2026, the smartest founders are not looking for the lowest headline tax rate. They are building structures that can survive due diligence, tax review, and future growth. That is where Cyprus can still be powerful, not as a shortcut, as a serious IP jurisdiction for real technology businesses.